Dave Ramsey's name has become a prominent name that is synonymous with personal finance and financial freedom. Through his radio show, books, and online resources, he has become a trusted source of advice and guidance for millions of people who want to eliminate debt, build wealth, and secure a stable future. Dave Ramsey's net worth is estimated to be around $200 million as of 2021, with a significant portion of his wealth coming from his real estate investments and other sources of income. However, it was not always like this for him since the beginning. According to him, at the age of 26, Dave was making $250,000 a year, and he also had a $4 million real estate portfolio. But 2 years later, he lost everything, and he had to start again from scratch with what he calls a new set of rules that helped him reach to where he is today. And in this video, we will go through 3 simple but very important rules that he mentioned in his recent interviews and cover what helped him turn his life around and achieve the level of success that he has now. But before we continue with this, make sure to subscribe to the channel and leave a thumbs up if you haven't already. Now, from a broad perspective, the basics of Dave Ramsey's investment strategy are very much similar to Warren Buffett's approach and what he usually preaches and talks about. For example, Dave's main point is to invest in things you genuinely understand and love, rather than falling for investment that sounds sophisticated, which is also what Warren Buffett refers to as his own circle of competence. Everyone usually has a natural ability to understand something better than others, whether that is real estate, technology, commodities, or even cryptocurrencies. And by defining what a person's circle of competence is and by mainly focusing on it, is how an investor could form a hedge against disastrous mistakes and succeed in the long run.
Put money in stuff you understand and you love, and don't put money in stuff because it sounds fancy, or somebody, it sounds sophisticated. Because there's something that happens when you get money. You think that everybody that has money is sophisticated about their investing. And what I figured out was almost no one is.
Yeah.
They're very primitive. I mean, a lot of people I talked to were farmers, and you know what they got? Lots of land. They got dirt, man. That's it. Just dirt. And it doesn't even, they don't even necessarily plant it, but they just buy dirt. And one guy had 8,000 acres of dirt, and I'm like, God, in Kansas, I'm like, golly, I wouldn't even more, because I don't know anything about that kind of dirt. I like real estate, but that would scare me to death.
Yeah.
But for him, it was the most comfortable, natural thing in the world, to your point. And so I just learned that put money in stuff you love and you understand. Don't put money in stuff because it sounds sophisticated, because you're getting ready to lose your butt, because you're trusting some guy who doesn't have any money, who's trying to sell you something. Because I was starting to make bank for the first time, and I'm like, I need to be like doing double backflip limited family partnerships or some kind of crap. Yeah. I don't even know what they are, but I probably ought to be doing one if I'm making this kind of money. And then you talk to a guy and he's like, yeah, you ought to do a double backflip with a twist. And I'm like, yeah, but get right up to it. And I'm going, I don't half understand. No, I think I'd rather just bury it in the backyard than that, because at least I know where it is,
One of the very prominent things about Dave Ramsey's investment strategy in real estate is that he is very cautious about using debt and totally against it in general. His strategy has been criticized by many renowned investors within the real estate space and even beyond that, especially during the last decade or so, when we were seeing low interest rates that are close to 0%, which in turn made taking on a lot of debt very much attractive. However, this now is not the case anymore when the Fed is raising interest rates and trying to combat inflation and keep it under control, due to years of very cheap borrowing policies and too much printing of money. And many of the investors who took on a lot of debt and became over-leveraged are now experiencing the harsh consequences of such financial decisions, including banks. We saw how 4 banks in the US alone went bankrupt this year, with many other banks also currently laying off employees quietly, with more layoffs expected to come. This indicates the pressure of the current high interest rates policy on these banks and the need for them to reduce their costs due to a high level of uncertainty in the market. All of this takes us back to Dave Ramsey's point of view, where he says that debt is not always a good thing to bear.
Now, that line is actually from Warren Buffett. He, in one of his famous annual reports, they're very cheeky and fun to read, and especially the opening paragraphs or so. In one of those, he was talking about in a down year like '08. We soon discover that leverage is not always your friend.
Yeah.
That, those of us that can do math realize that any number multiplied by 0 is going to equal 0.
Yeah.
And that does that for you. So yeah, it's again, having grown up in the real estate business, one thing you're going to do in the real estate business when I was growing up, if you said I'm going to be a real estate investor, they took you to the hospital, they took out your risk meter, and they broke it with a hammer. and they put it back in. You're not allowed to perceive risk if you're going to be a real estate guy, because it's glass half full. We're eternal optimists. Everything's going to work out because real estate's always awesome. It's just awesomeness on parade. You can't mess this up. The renters will pay your rent. Oh God, I'll pay your mortgage. How can you mess this up? And so if a little bit of leverage is good, then a lot of leverage is amazing. and that's how I went broke.
Yeah.
I leveraged up to my eyeballs had a bunch of short-term notes, and the bank did the unthinkable and called my notes when they got sold to another bank, and they saw a 26-year-old kid owed them $1.2 million on the 90-day notes doing flips. And this was before Chip and Joanna told us how to do it, and so do a flip. Oh my God, we didn't have HG to channel to tell us how to fix up a house.
Now, Dave Ramsey also advises people and his 40-year-old version of himself to play the game for the long run and not expect quick and easy wins. He mentions that many people usually hope for a simple solution like one phone call to fix everything, but that's usually not realistic. Financial success, according to him, takes many experiments and sometimes a lot of losses and mistakes in order to eventually make it. If we compare his advice to Warren Buffett's advice, we can find many similarities. Warren Buffett's success is actually not the result of one giant home run, but rather a series of smaller successful investments. And this is also what Dave Ramsey talks about. This is in addition to investing for the long term and not putting all the money in one place and in a single investment. One of Warren Buffett's mistakes that he once called a $200 billion blunder was his initial investment in Berkshire Hathaway, which he described as the dumbest stock that he ever bought, regardless of how this investment has ultimately turned out. He said that the reason for this is that Berkshire Hathaway was a failing textile company initially, and it took Warren Buffett some considerable time to recoup his investment. Even though the same company now has probably the most recognized and respected names in the whole global financial market. Dave Ramsey also refers to a lot of mistakes that he made at his company, which he had to learn from to get to where he is today.
Play incremental long ball. Don't look for the home run. I keep waiting for somebody to call me and for this to get easy. One phone call and it's all over. And it's like, oh, now I don't have to think about it anymore. Someone else is going to do it for me. It's all automatic. It's never going to be automatic. It's never going to be easy. It's a hustle and grind. It's a claw. You're going to make a bazillion mistakes. Make mistakes that are experiments that you survive. You put out a hypothesis, you survive the experiment. To live another day to have another experiment. Put out another hypothesis, another product that fails, another idea that fails. And our failures at Ramsey are in number and in money are way greater than our successes. The only thing is we survived them. A, we didn't have debt, and B, we never bet the farm on one horse. And so from a diversification standpoint, we never pushed all the chips to the middle of the table on one hand. And so we're not looking for the singular home run. We're looking to survive and fight another day and keep iterating. And the culmination of that, the accumulated value of those iterations are what we call the gleaming mountain of success, which turns out as a pile of garbage and mistakes that you're just standing on rather than laying under it.
So in conclusion, the principles of successful investing are very similar according to both Dave Ramsey and Warren Buffett's approach. These principles come down to being careful of taking on lots of leverage and miscalculating its risk, investing in what you know and within your own circle of competence, in addition to investing for the long term. Any other investment that sounds too sophisticated and hard to grasp is usually a bad investment that should be exercised with a lot of caution. Since this is how many investors, banks, and even large financial institutions usually make big disastrous mistakes that they cannot recover from. Like what we saw happening back in the 2008 financial crisis, where large financial institutions lost trillions of dollars on their investments by investing in subprime mortgages and complicated credit derivatives, which led to a whole global financial meltdown. So that was it for this video. If you found this helpful, you can click here to watch this one. Other than that, make sure to leave a thumbs up and to subscribe to the channel. And with that being said, see you in the next one.